Hello, I'm Kurt. I'm a value investor. And yes, today we're going to touch the untouchable PayPal, analyze the stock. Why has it been down so much? Is it a value trap? Is it a value opportunity? I know I'm wading into dangerous territory here because for years, months, value investors have been calling PayPal an undervalued stock. Why is this company a good investment right now? Because the price has fallen so much. And why is the company not a good investment? Because it's still a value trap, it's a melting ice cube, all that stuff. So let's take a look. Just note that this includes financials from the most recent earnings report, including up to Q4 2025. So with that, let's talk about what's been going on. Yes, of course, if you had invested $10,000 5 years ago into PayPal stock, you would be down to under $2,000. You would have lost a lot of money, 83% decline. Why? What's been happening? This is the last year price chart. People are starting to call this, or have been calling this, pain pal, which, yeah, I mean, I agree. It's been very painful if you've been a PayPal investor. I haven't been invested during this time. I covered the stock a few years ago and said it was worth $90 when it was about $60. Of course, it ran from 60 to 90. Since then, it's been pretty bad. In fact, if you had invested earlier last year thinking, hey, it's recovering, it's coming back up, you would have bought around $70 to $80 and you would have lost about half of your money because now the stock is just about $40 a share. Why did this big dip happen right here? Well, it was already $52, I think, dollars a share before earnings and it dropped big time. Let's take a look. Here was their earning highlights here. They missed on revenue by a decent amount, quarterly revenue. They missed on earnings per share by a good amount. And yes, they beat estimates on total payment volume, up 9% year over year, but their transaction margin dollars, pretty not that great growth, 3%. Active accounts only up 1% year over year. And that's the big news, the CEO transition. People on X were posting, PayPal is dead, it's over, I'm throwing in the towel, there's no other way to say it. It dropped 17% to begin the day. I think it was down 20% after earnings were released. The biggest news, of course, was this guy right here. Yep, he's gone. They dismissed the CEO that's been there for the last 2 years who said, we're going to change the world. Well, PayPal did not change the world. Okay, now price way down. Now is it an opportunity for it to change your world? If you buy the company, maybe you get a rebound. Yeah, why did this happen? 1% growth, like we said, pretty bad. Guidance down. Yeah, this isn't great. And people saying, I'm looking for an exit. Adios, PayPal. People are out. A lot of people on X were saying I'm out. Then since the earnings, a lot of people had said, well, based on the price decline, I'm in. And a lot of people have been calling this a great value opportunity. By the way, this is the guy who's going to replace Alex Chris. His name is Enrique Lores, and he was an executive at HP during their cost-cutting measures and sort of, I guess, tried to turn that company around. It's gone okay, I suppose. But let's talk about PayPal. What is their business? Why and how do they make money? That's the most important thing you have to understand about a business when you're investing. How does the company make money? How does it operate? Well, PayPal, it has a digital payments platform. Some of the biggest brands, obviously Venmo, the big, so to speak, network effect that they have. A lot of people just have the PayPal app. So those are big, network effects. Lots of people just have accounts with them and they've hooked up their bank accounts to those apps and money flows from person to person or person to business through those apps a lot of the times. Online purchases, quick, easy pay buttons, that type of thing. The big thing that Venmo and PayPal want to be is a merchant to customer connection to send, receive, and manage money online and through mobile devices. They have a 36 now, I think about $38 billion market cap. It's fluctuated in the last few days as I've been preparing these slides. Now that's 87% down from that 2021 high. We'll take a look at that price chart. They have 24,000 employees, which is pretty huge because I just released a video on NVIDIA and they had 36,000 employees. And they're a multi-trillion-dollar company. This is a $36 billion company, and it's got 24,000 employees. So you could say probably has some froth here that they might want to look at, and that new CEO might be addressing sometime soon, based out of California. And they just initiated a dividend. We'll talk about that. Trailing PE around 7 to 8, and their free cash flow earnings is north of $5 billion a year right now. They're trying to get into buy now, pay later, which is a big market right now. A lot of companies trying to get into that space, which they're calling PayPal paying for, or maybe they're not calling it that anymore. I don't know, but they also have credit cards, debit cards they're issuing. And of course, the new opportunities here in artificial intelligence with all of these different AI assistants and bots and ways that customers can go on and talk to AI about what they want to buy and make purchases through. That's the agentic commerce opportunity that PayPal's trying to take advantage of, but this is sort of new and it's not so sure. But they have agreements and deals with Google, with OpenAI and different partners that potentially PayPal could have PayPal could allow customers to just buy that item that they want to search for within the AI sphere, when they're talking to those AI bots. And so that's a potential opportunity. I don't know how that's going to work out for PayPal. Here, PE ratio of 80, up at $300 if you had bought at the peak in about early 2021. Why would you buy here? I don't know. 80 PE. Maybe this is a lesson if you're buying Palantir or something else with a PE ratio that high, of what can happen to you if what's seemingly a amazing exploding business that's growing really fast and so dominant. What can happen if the story, the narrative, and the growth numbers start to turn just a little bit? Boom, all of a sudden you're from 300 down to 100. And then from there, it's just a matter of things don't go your way. Growth isn't as it was imagined. And now here we are, PE ratio less than 8. So that's a decline of 90% or whatever it would be there. So definitely don't want to buy here at the top. If you had you're definitely screwed. It's definitely PayPal, all that stuff. But what about now? What if you buy at a PE ratio of 8? Is it going to go down another 80%? Let's see, what are the possibilities of that? I mean, at a PE ratio of 8, you're pretty unlikely to fall another 80% unless the business dies or goes bankrupt, right? So maybe this is a good opportunity to buy. Still not that different from these troughing areas, but not a lot of faith, as we saw in the previous slide, in PayPal's business right now, going through a lot of change. This can maybe partly explain what's going on. Here's their revenue trailing 12-month data. And if you look at the annualized numbers here, 10-year growth, like if you look back 10 years, annualized growth has been 14% per year in revenue, which is pretty good. But if you look at the recent years, like the 3-year annualized growth, and this growth rate right here, 6%. So that's a big difference. The business is slowing down in terms of revenue growth. They are still growing. So if you're forecasting decline from day one right now to just decline 3% per year, you're not really being realistic with the numbers, unless you expect some amazing, like huge change right now today. Maybe in 10 years you can expect negative numbers. But today they're still growing 6% per year over the last 3 years in terms of revenue. Profit, great numbers. They had this big run up, of course, during COVID. People maybe buying online or sending money to each other online. Traditional methods of payment weren't working as well, but then they came back down to earth. But since then, actually profit has gone up a lot. So if you just draw the line straight through, that's 15% per year growth over the last 10 years. And it's not really slowing down too much. I mean, this rate of growth is still pretty decent. But there's a lot of speculation that as that revenue slows, that unless they're able to keep expanding margins, this is going to start flattening. And so, yeah, that's a real concern. Analyst estimates over the next 2 years range from negative 2% per year for the next 2 years, that's 2026 and 2027, all the way up to a high of 20% positive growth per year. That's two very different outlooks. So what's it going to be? I don't know. Let's take a look at free cash flow. This one is a lot more steady. Why is free cash flow not growing as much as profit? Well, there's a lot of different answers to that question. We've talked a lot before about the difference between free cash flow and profit. For this company, PayPal, I'd err on the side of looking at profit as a proxy for the money that's available to shareholders. But it just depends on the cycle that the company's in. This still 10-year growth, 12% per year, but very flat over the last few years. And maybe this is the chart that more people are looking at going, I need to not fall from 7 billion trailing free cash flow per year down to 5.5. That's a pretty big decline. I want to see growth. I want to see this thing moving up. Well, it's not moving up right now so fast. So what does that spell for the future? Now, if you were to go back to PayPal a year ago and say, what's the bull case for PayPal? A lot of people would be saying they're buying back shares. Now, share buybacks are not in and of themselves a great case to make for a company. I mean, yes, it's a method that the company can use to return earnings and cash to the shareholders, but it can be done very poorly. We've seen executive teams make very poor decisions traditionally in the last 10 years on when and how to buy back their shares. I think in PayPal's case, they've been buying back these shares super aggressively at a good time when their share price has been reasonably valued to undervalued. And I don't expect that to change too much. You can see the accelerating change. I mean, if you go back 5 years, you're going to see 5% per year reduction in shares outstanding. And keep in mind, this axis starts from zero. So, I mean, that is a very, 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 very aggressive buyback trend. Right now, they're buying back 6 to 7% of their shares per year. I don't expect that number to be the same going forward for the next year or for the next 3 years, for instance. It'll probably be a bit lower. But if the price of the shares, if the share price stays as low as it is, they'll probably just continue to choose to do that, especially if they don't see a lot of ways to reinvest that money back into the company. So that's kind of what you have to ask yourself. Are there better opportunities for them to be spending this money other than buying back the shares? If there is a good opportunity, it would be better to, get returns on invested capital. But this is more of a surefire way for the investor, for the shareholder to get money back from the company, from the investment directly. So when we look at the per share profit and free cash flow, here's what the trend looks like. I might actually have these labels backwards, but you get the picture. Growth numbers that are a lot higher than their actual earnings and free cash flow just because they're buying back shares, making it look better on paper. So when you see earnings per share growth, that's with a grain of salt. You have to put all the puzzle pieces together. Yes, they're buying back shares, they're getting higher earnings per share, but how sustainable is that if it's all coming from buybacks? But are they actually growing their earnings and free cash flow? Yes, they are. So put the puzzle pieces together again. Return on invested capital trend has been going pretty well for PayPal. 10% is that line there that I like to see companies be able to consistently get returns on invested capital above that amount. They've been doing that and trending in a positive direction. So maybe this pessimism on PayPal is a little bit unfounded according to that, but we've seen a few different angles here. PayPal, good. Okay, they're doing some good things. PayPal, bad. They're doing some bad things. On their dividend history, they just in late 2025 initiated a dividend. I mean, they didn't have a dividend for a long time. Now they're starting to return cash to the shareholder through buybacks and now also through dividends. We don't know what they're planning on doing with the dividend payment, like increasing it. They haven't really announced increases. They just started this, I think, in October, November last year. So right now it's a 1.4% annual dividend yield. It started a lot lower because their share price was a lot higher. But because the share price has fallen, that 14 cents a share annualized, it's actually not that bad of a yield already. So that's part of what you're buying when you're buying PayPal at $40 a share. A look at their balance sheet. The big thing here, 38 billion of their current assets and 40 billion of their current liabilities is basically a wash because that's the money that's in customers' accounts. So it's a liability and an asset at the same time. Overall, they're a bit of a clunky balance sheet just because of that nature. They're sort of like a bank, not really a bank, but I make my own adjustment to their assets just so that we're not looking at a $20 billion book value. We're actually looking at an $8 billion book value. That's to be conservative and make sure we're not over amplifying some of these things. I mean, yes, they have $8 billion in cash. They have $11 billion in intangibles. Okay, let's just take their $8 billion and walk away and call that their book value. That's what we're going to factor in when we do a fair value assessment. Here's a look at their business pillars. It's a little blurry. Sorry, I just copied this from my spreadsheet. A lot of green check marks here. I mean, okay, valuation, of course, check mark. Return on invested capital, good in one sense, not the best in the other. I said 10% a couple slides ago, but really 15% makes me super happy. So half and half. Maybe they're closer to having a check mark here than not having one. But I'm a little bit nervous about the revenue growth trajectory. Yes, they've checked off the revenue growth check marks, but in the future, are they going to keep checking them off? I'm not so sure. Net income, same thing. Free cash flow, they've already got the red X because their free cash flow has been too variant. It hasn't been consistently up. We can't project that as well. So they don't get the green check mark there, meaning it's a 6 out of 8. Potentially this could go lower, and that's part of the concern why people are freaking out. This company's not as fundamentally sound as we would like it to be. On debt, though, I have them with a check mark. I think overall balance sheet's pretty good. They're obviously buying back shares. How sustainable is their continued growth? I mean, we know they're growing pretty well. I mean, they've been growing pretty well. Their growth is slowing, but it's not like 1%, 2%, 3%. It's more like 5, 6, 7% over the last few years. So maybe in 1 or 2 years, you're going to be looking at this company going, yeah, they've only got 4 pillars checked off and, half, something like that. So let's go ahead and run our discounted cash flow model here to see what's going on. What's the true valuation? What should we be paying per share? Well, base case, I'm going to give them the benefit of the doubt. I mean, people aren't willing to give them a benefit of the doubt right now. Apparently on Wall Street, this is not going to fly. 7% growth per year for the next 3, not going to fly. But I'm looking at their numbers and saying what's going to materially change over the next 3 years. They're not going to go to negative growth. In my opinion, most likely. The most likely thing is they're going to keep growing how they've been growing, continue to slow a little bit, 7% over the next 3 years, 5% the next 3 years after that, and 3%. In 10 years from now, yeah, they'll be growing very slow. They'll basically just be a slow growing machine. Price to free cash flow of 10, discount rate 9%, which is a decently high discount rate. I do have them buying back 5% per year of their shares in the first 3 years, 3.5% after that, 2.5% after that, with the dividend actually growing 7%, 6%, 5%. Yes, those numbers are higher than these numbers, but they have some wiggle room on the outset. So they're going to start to fill in the shareholder return with the difference. And eventually the dividend will level off. But, at that point, that's why they're trading at 10 price of free cash flow. Well, right now they're trading at 7 price of free cash flow. So, I mean, I expect them to return to a more normal valuation with continued steady, moderate growth. That's my base case. Now, you could say that's terrible. That's not going to happen. They're going to grow way slower than that. Kurt, you're completely wrong. Okay, plug in your own numbers and get your own value. But in my base case, that's an expected return. If you hold the stock from now for 10 years of 12% per year, which is not that bad, it's actually pretty good. It's higher than this discount rate. That's why the intrinsic fair value is $58 per share, which is a margin of safety of about 35-40%. So if it were to correct in the next year back to fair value, that's a 35% gain if you add it in your portfolio right now at $40 a share. That's not too bad in the base case, but you have like a variation of possibilities here. I run in my model, change the price to free cash flow a little bit this way, that way on a normal standard deviation. change the discount rate this way, that way, a little bit lower, a little bit higher, change all of these numbers a little bit lower, higher. And here I get my distribution of outcomes. And the distribution of outcomes is telling us, how frequently we would make the return that's shown here on the bottom. So yeah, you can see this is out of 2,000 iterations. So 200 count would be 10% of the time we're getting between 7 and 9%. 10% of the time we're getting between 9 and 11%. But here, between these three guys, maybe 10, 15%, maybe 25% of the time, we're getting between 11 and 14% return. So pretty good chance in my base case for very good returns, and really a very minimal chance of a negative return over 10 years. And even if you look at like the probability of getting less than 5% return, pretty minimal. But that's, of course, if these assumptions are correct. If these assumptions are not correct, then no, this could shift totally. But you even have mirroring these lower return scenarios, you have some scenarios over here almost at 10% of the time that you're getting 16 to 18% returns, and even higher, above 20%. There's some tailing there. But for the most part, I see pretty good returns right there, and 3.9% per year goes back to the shareholder in buybacks and dividends if this is the case, which is a pretty good guaranteed sort of return. Now, let's say in this case, the good valuation, they execute, they grow, they do better than expected. Maybe they not do so amazing growing 20% per year, but let's say they grow 9% per year, then 6%, then 4%, slightly better. And let's not give them a $3.8 billion base year free cash flow. Let's give them $4 billion. Let's say that we don't have as big of a recession. And right now it's over 5, but we're always correcting down and starting from a lower number, accounting for the potential of some sort of recession or slowdown. And let's say in 10 years, they trade up 14 times because they're growing still 4% per year. Very good moat, something like that, trading 14 times free cash flow. Pretty realistic. I could see that in a good situation, good scenario. They buy 5.5% per year in their shares back in the first 3 years, then 4%, 3%, and they're growing their dividend faster to keep up with these growth numbers. They're able to return a lot more cash back to the shareholder, 4.4% per year in these two items. And the discount rate, let's just make it 8.5 instead of 9. If this was the case, then we expect 18% per year returns, base case median value. That's pretty good. I mean, I'm setting out for 18% return. That's the kind of return I want. But this is not the base case. This is the good case. So you have to think risk and reward. What's the risk on the bad case? We'll get there in a second. What's the reward in a medium to good case? I mean, what can I get if things go well? Well, there you go. I mean, and not just that, we even have some probabilities here that are pretty high of getting 20%, 22%. So, okay, I mean, here's the reward side of the equation. Fair value under this assumption is $100 per share. That's pretty good, 140% higher than where it is today. So yeah, I'll take a 140% correction. I'll take doubling my money and even more. I'll buy it here at $40 per share, ride it up to $100 per share, and we'll call it a day. That sounds pretty good, but that's only accounting for the reward. What if the bad case happens? What if what Wall Street thinks is going to happen right now actually happens? Because everyone keeps selling this thing, right? Let's give them a base year free cash flow of $3.2 billion. Recession. They can't execute. AI, agentic commerce, no, it doesn't work out. Competition, Apple Pay, Google Pay takes away their ability to make money on total payment volume. They only grow 3% per year for the next 3 years, then only 1%. Then they start to decline, 3% per year. They start to die. This is a dying business. In 10 years, it's going to be maybe even lower than 5 billion, and it's 20 years from now going to be so bad shape. Okay, what does that look like? 7 times free cash flow multiple. They're only buying back 4% per year in dividends, then 2%, then 1%. And the dividend, by the way, 5%, yes, growth per year, now 3%. But by the time they're losing money, they have to pause and maybe cut their dividend. they're only returning less than 3% per year to the shareholder in just base buybacks and dividends 15% of the time. Only 15% of the model iterations on this case show that their current value is greater than the current price. The true value is greater than the current price. That's not great. That's not a great probability for success. And the expected return here, by the way, only the 3%, because the price is going to be pretty much the same today as it is 10 years from now. And you're just going to get this 3% yield. It's going to sell for some, 30 some, 40 some dollars per share in the future. That makes today's intrinsic fair value only $22. You should pay $22 if you want a 10% return, basically, buying this company. That's pretty low. If it were to correct to this value here, that's losing 50% of your money if you buy today, almost 50%. So that's the risk and reward. So what do I have to say about PayPal? I mean, here's the thing. Is it a great opportunity? Possibly. Potentially. You have to ask yourself what can go wrong here. More competition in the space. The buy now pay later is going to get competition. You're not able to execute on some of those other strategies. You have mismanagement. You have a cycle of getting rid of CEOs. Not very great. Your employees don't know how to execute, don't know how to drive the business forward. That's what the market expects to happen right now. That's what they're pricing in, something on the negative side. But you also have to ask yourself, what can go right? AI, agentic commerce, plugins for people going on Copilot, Gemini, asking about products, recommendations, option to buy now, right now, connected to the PayPal account. Okay. Maybe, it hasn't really succeeded so far. Maybe buy now, pay later, collecting on interest. That's not the best way to make money, but maybe it will drive some of their margins up a little bit. And here's the big one, 24,000 employees. Let's get rid of 10% of them. That's what Lores did. Last time he took charge at HP, he was able to cut 10% of employees and save billions of dollars. He could do the same thing here. 20% reduction would be at least $1 billion in savings, I think, on a company that's netting $5 billion. That's pretty good. Let's get the efficiency up, and what happens then? That could be a turnaround type story. I think even if the company does mediocre, then yeah, you still have the possibility for a high return, 35% below intrinsic value, or maybe 140% below intrinsic value. That's not that bad, but again, that's if they hit mediocre targets. But what happens if they don't even get there and they have a sort of negative outlook? And yeah, they have good pillars, but again, revenue slowing, earnings slowing, return on invested capital not so great because you're not able to execute on those things. Then you're back to 3-pillar, 4-pillar, 5-pillar business. I'm not so sure what's going to happen to that kind of a business over time. So what's the risk and reward? Risk, you lose half your money. You buy this company, it continues to melt like an ice cube. You collect tiny little dividends, and the buybacks, yes, they're happening, but earnings are not growing. Multiple keeps going down. You pay $40 per share now, and you get $40 per share in 10 years. That's maybe what will happen. That's the risk. You shouldn't have bought. You should have bought Palantir. You should have bought NVIDIA and made 10x your money over the next 10 years. What are you doing buying PayPal? On the positive side, the reward, you buy it, they hit mediocre expectations. The price should come back. The dividends, the buybacks, they're going to be great. You're going to make 35% swing, or you hold it for 10 years and really make what would be equivalent of buying it and getting $100 worth of value today. So fairly good opportunity. I think if it goes back below $40 a share, loss of faith keeps dropping. Let's say even gets close to $30 a share, probably a good opportunity to buy if you can handle that risk, if you can stomach that risk, and buy it wait, see what happens at $60 a share, maybe reevaluate and hold. Maybe you go all the way for that $100 target if things have changed, or maybe you call it a win and you just made 50% returns. That's all it takes to get 50% returns right now, is just going back to $60 a share. Is it going to happen? I don't know. I can't tell you. I'm not going to take the risk, 50%, losing 50% of my money. But when nobody is willing to take the risk and everyone who would sell and who wouldn't buy is now out, that might be the perfect time to be in. I don't know, but let's see what happens to PayPal. I think this is the last video I'll do on it in a while, but let's see. Always looking at companies with that mentality of value versus price. I don't care if the company's not going to grow 20% per year. I don't care if the company's not going to take over AI and take over the world. I just need the value, the true value of the future earnings to be better than the price that I'm paying now by a good amount. If it's a decent company, that helps out. So we're always looking at value versus price, risk versus reward. Yes, I don't know what's going to happen in the future, but if the risk, the downside is pretty low, if the reward is very high, that can trigger a buying opportunity. But you have to be comfortable with the assumptions, and you have to have the conviction that yes, this company's going to 60, it's going to 65, 70. Or you could say, I know they're going to grow at 9% over the next 3 years. Maybe you wouldn't be so confident in that, but then you would say, I have conviction it's $100 a share. So with that, make your own decision on PayPal and let me know what you think. And best of luck investing, and goodbye for now.